Hello everyone and welcome to this week's episode of Kickstarter Real Estate Investing. In last week's episode, we spoke about what are the three main criteria you need to look at when you're looking for single family homes in a buy and hold strategy. Okay, so the three criteria which we spoke about, one was how much money you can afford to bring to the table for buying a particular rental property. Second was how old the house should be. Should you be looking at a new house or should you be looking at a house which is a few years older? And the third criteria was how far should your rental property be from where you are located. Whether you should be like half an hour drive away, 1 hour drive away, how far you want to go as part where you look for your rental property. Okay. So in this week's episode, I will drill down on the first item, which was how much money you need to bring to the table when you're looking at real estate investment properties. So what are the different things you need to keep in mind when you're looking to put money on the table for buying a real estate property? Okay, so if you really think from a perspective, let's take an example. Let's say you have $50,000 in cash available in your bank, which you're ready to invest in this particular investment property. Okay, so if you really think from a perspective that you're going to do like a conventional finance, so in this case, you're going to put 20% down payment towards the cost of the house. Okay, so let's say you have $50,000 and you might do a quick calculation and say, yeah, $50,000 should buy me a house worth $250,000, because if I make a 20% down payment on it, which is $50,000, then I should be able to afford a house of that price. Fair enough. That is correct from a down payment perspective. It is correct that you will make a 20% down payment and be able to get that house from a loan perspective. But there are also other costs and other things you need to keep in mind when you're trying to buy a rental property. So when you're closing on a rental property, or a property which you're going to rent out, the things you have to keep in mind is, one is obviously the down payment, right? So we already spoke about a 20% down payment which you need to bring to the table. Now the next cost you need to think about is, what are the closing costs, right? So when you're going to close on a particular property, you want to see what are the different costs you need to bring to satisfy the closing requirements for that particular transaction. So what are the common closing costs which you'll face? Well, some other closing costs are going to be loan related, which is going to be, okay, if you're buying something and if you're trying to bring down the interest rate, there might be certain points which are charged for interest rate deduction. There could also be costs which the bank will apply for the loan you're taking from them. So it could be like appraisal costs, loan processing costs. There are a bunch of fees they will charge you for that. And then there are the prepaids also. So when you're going to buy this particular property, the bank wants you to make sure that you have insurance from day one, right? So the homeowner insurance which you need for your property needs to be there from day one. So they'll take a prepaid insurance of 1 year for that particular property. And they will also keep 3 months of prepaid insurance in escrow, just in case you need to go ahead and then after a year, you're going to go and renew the insurance. They want to make sure they have 3 months of prepaid insurance as reserve. They do the same with property taxes too. They give up to 3 months of prepaid property taxes. So they calculate based on the cost of the home. And if it's already a house which has been in the market for some time, or it has been built many years back, they already have the property taxes history. And from that, they can say, okay, this is what the 3 month property tax history cost is going to be. And that's what they will put on that particular property. So when you look at all your closing costs and you add it all up, so there is obviously the loan processing fees they will apply. There are the prepaid expenses you might have, and there is also property taxes, which they will take on a prepaid basis, and the down payment which you need to bring. So when you add all these things up, what the amount of money you need to bring to the table is a little more than just the down payment. Okay. So now if you think about it, you had $50,000 which you could bring to the table. Let's assume $6,000 goes into all this closing costs, which was, if you're taking a points down, the loan processing fees, and the prepaids which you bring for your insurance and property management for the escrow, right? So when you add all that, let's assume it's $6,000. Now, instead of $50,000, what is left for you is $44,000. Okay. Now, when you think from this perspective, the third thing which you need to keep in mind is the bank which is making you a loan also wants you to keep some part of your money as reserves. So they would like to see some liquid assets you keep as reserves, so that when you're renting out your particular property, and if you do not get a renter for the next 3 to 6 months, you're still able to make your mortgage payment. So generally what they would like to see is at least 6 months of reserves of your monthly mortgage payment to be kept aside so that in case you're not able to rent the house out sooner, you're not sitting there waiting for someone to come and rent it so that you can make your payments. So generally they will say that keep aside 6 months of your monthly mortgage payment as reserves, and I would like to see some kind of a bank statement or some kind of a statement which shows me that you have that money to keep at reserves. So take this example. Let's assume your monthly mortgage is around $1,500, and if you take that for 6 months, the bank would expect you to show $9,000 in liquid set aside from your regular down payments and everything else set aside so that you have enough money to make the payment for the next 6 months on the loan. Okay, so if you think from this perspective, you are also have to keep aside a bank related mortgage reserves so that you are able to make your mortgage payments. Okay, now if you look at what your money you had was, you had $50,000, you put $6,000 on the side for your closing cost, and now you're keeping $9,000 on the side to account for reserves which you need to keep for your mortgages and things, right? So now if you quickly deduct all that, you get what is left is $35,000, which is $50,000 minus $6,000 of your closing cost and prepaids, and the $9,000 is the reserves for your mortgage payment, okay? So now you have $35,000 left. So when you go into the market now, you should be looking at a house worth around $175,000, because $35,000 is 20% is $175,000, 20% is $35,000. So that way now you can go and look at properties where you can easily not only make the down payment, but you're also keeping reserves on the side to make sure that you have enough money to pay for the expenses, the prepaid, the closing cost, and also keep reserves. All right. So it's not as simple as just saying that, okay, I have $50,000 in my bank, so that's the money I'm going to use as a 20% down payment, and that gives me, which I can buy $250,000 house. What you're left with all the expenses and which is kept on the side is actually, you can only buy up to $175,000 worth of house, because there are other things you need to take into consideration when you buy the house and the expenses you might have. Okay. All right, folks. So this was the first one of the 3 criteria which are there. In the next episodes, I'll go into the remaining 2 criteria, which was like the age of the house, the pros and cons of which kind of house you should buy and how old it should be, and also in terms of what neighborhood you should be looking at. Okay. Hope you like this episode. If this was good, go ahead and like and subscribe to my channel, and I'll see you next week. Thank you.